Faith can be a beautiful thing, except when it's misplaced. Welcome to JRC Bureau and the 15 Steps to Becoming a Successful Investor in Any Asset Class playlist. Episode 4 is all about your unrealistic expectations. When you invest, how much do you expect to receive in return? A survey suggested that some investors have unrealistic expectations that could affect their long-term financial security. Investments, experience, volatility, and their value will rise and fall. In most cases, you should only invest with a minimum time frame of 5 years to allow the peaks and troughs to smooth out. Perhaps you could make an exception for cryptocurrencies. Ideally, you should retain some of your savings in an accessible account for emergencies. Worryingly, 10% of investors usually invest all their extra cash, leaving them financially exposed. All investments will have some level of risk, so you should consider what would happen if the value of your investments were to fall. Investment returns cannot be guaranteed, and the potential returns will vary depending on the investment. Side note, if you are interested in getting bankrolled from $25,000 to $10 million to trade cryptocurrency or any other asset class, check out the links below. For the crypto purists, I have an exchange for you to trade from in the link below, as well as a state-of-the-art cold storage wallet that holds cryptocurrency, NFTs, DeFi assets, dApps and so much more. Are you looking to manage your crypto portfolio from one place and keep track of your profit and loss at any point in time? Then check out the CoinStats link. Back to the dangers of unrealistic investment expectations. Investments not meeting your expectations can be disappointing, but it could have larger consequences too. Unrealistic expectations can mean you make decisions based on emotion and hope, perhaps desperation too. This can open you up to scams. If your expectations are skewed, you may not spot a scam until it's too late. Research found that just 35% of investors would avoid opportunities that promised high returns. Worryingly, 5% admitted they are less concerned about safety, and always look at investments offering the best returns. This is why scams are so prevalent in the investment world. In most cases, money lost to scams cannot be recovered. Taking your time to review investments is important. Keep in mind that investment returns cannot be guaranteed, and if it sounds too good to be true, it probably is. Experts believe that many individual investors are planning their future financial lives based on certain, misbeliefs about how markets will perform. Many of today's younger investors began investing after the financial crisis of 2007 to 2008, meaning they have only ever experienced most global stocks rising. Thus, most individual investors' expectations are high. As a result of these unrealistic beliefs, some investors are putting too little into their retirement savings plans, as well as allowing their overconfidence to impact their view on the amount of risk they should take. That's a wrap for today, my assassins. I'll try to keep this playlist short and painless. If you liked what you heard, please like, subscribe, and take a long position on the notification bell. Remember, when you play the investment game, you either become rich or you spend the rest of your life measuring the cost of your ignorance.